The harsh reality is that a vast majority of the population will never accumulate substantial wealth, and it has very little to do with their annual salary or their desire for prosperity. Instead, the primary culprit is a deeply ingrained behavioral flaw. The tendency to abandon the process at the precise worst possible moment, entirely unaware that the mechanism was just about to activate. Let's place the current financial landscape into sharp focus. As we navigate through 2026, a staggering 76% of American households find themselves operating without a sufficient financial buffer to weather an unexpected emergency. Even more alarming, 57% of the adult population confesses to living strictly from one paycheck to the next, leaving zero room for error or long-term accumulation. To make the future even more daunting, the average citizen now estimates they require a staggering $1.46 million just to step away from the workforce with a genuine sense of security. Yet, when we look at the actual data, the median retirement savings across all families in the United States sits at a paltry $87,000. This is not merely a statistical rounding error or a minor miscalculation. It represents a catastrophic chasm between current reality and future necessity. The root cause of this vast divide is not a lack of income, nor is it simply a run of bad fortune. It boils down to a singular, fundamental misunderstanding. People do not grasp the precise timeline required for the compounding engine to actually initiate its self-sustaining cycle. Many individuals operate under the illusion that compounding functions like a light switch, delivering immediate illumination the moment it is flipped. In truth, it behaves much like the heavy flywheel of a massive industrial generator. When you first apply force, the wheel barely inches forward. It feels like a futile expenditure of energy. But with persistent, consistent pressure, the momentum builds imperceptibly until a critical velocity is reached. At that exact tipping point, the flywheel's own momentum surpasses the energy you are feeding it. Most investors turn the key, wait a mere 30 seconds, feel absolutely no forward thrust, and simply walk away, abandoning a machine that was on the verge of igniting. Today, we are going to dissect the exact instant that engine fires. We are going to examine the empirical data, the unvarnished numbers, and the specific chronological juncture where compounding shifts from being a burden you actively fund to a dynamic force that actively funds you. Whether you are a novice who initiated your first deposit last month, or a seasoned accumulator who has been in the trenches for 15 years, this understanding will fundamentally recalibrate how you perceive your portfolio. Let us begin with a candid, introspective question. If you are already investing, how does it genuinely feel? If you are being completely honest with yourself, the answer is probably some variation of monotonous, and perhaps even futile. You transfer funds each month, you observe the balance inch upward by an almost imperceptible margin, and then you return to your everyday routine, desperately trying to suppress the anxiety induced by the fact that you need a 7-figure nest egg while your current balance languishes at a mere $14,000. That specific sensation of boredom, that nagging feeling of pointlessness, is not a diagnostic signal that something is broken. In reality, it is a quiet confirmation that everything is functioning precisely as it should. However, because no one explicitly articulates this reality to the average saver, millions of individuals misinterpret this monotony as a symptom of failure. Consequently, they halt their contributions, they liquidate their holdings, they redirect their capital toward more immediately gratifying ventures. That singular decision, that one isolated moment of impatience, ultimately carries a financial penalty larger than almost any other misstep they could possibly commit. To understand why this happens, we need to examine the underlying mathematics of the early accumulation phase and the reason it generates such lackluster emotional feedback. The S&P 500 has historically delivered an average annualized return of approximately 10.42% over the last century. On paper, that figure sounds extraordinary, and indeed it is. However, there is a significant caveat. The 10% return feels utterly uninspiring when your principal balance is minuscule. For an individual with a $10,000 portfolio, a 10% appreciation translates to a mere $1,000 gain. That is significantly less than the average monthly grocery expenditure for a family of 4. It fails to impact your overall lifestyle, and it generates no tangible sense of achievement. As a result, your brain, which is evolutionarily hardwired to seek immediate feedback and tangible rewards, concludes that the strategy is fundamentally flawed. But your brain is operating on outdated instincts, and I can demonstrate this fallacy with irrefutable arithmetic. Let us navigate through a concrete, data-driven scenario. This is not a hypothetical parable or a fictional character. It is a realistic projection anchored in verified historical averages. Consider an individual we will call Veronica. She begins her investment journey at the age of 25. Her strategy is straightforward. She allocates $400 on a monthly basis into a broad market index fund, avoiding exotic derivatives or speculative sector bets, simply a standard tracker of the S&P 500. We will utilize a conservative average annual return of 10% for our calculations, as the index has consistently hovered around this benchmark since its formal inception back in 1957. During her first year, Veronica has contributed a total of $4,800 from her earned income. Her account balance after market performance sits at approximately $5,040. The market added a mere $240 to her total. To put that in perspective, she generated less from a full year of capital appreciation than she could earn from a weekend part-time job over a fortnight. That is technically progress, yet it registers as nothingness in her daily consciousness. Fast forward to year 3. Veronica has now injected $14,400 into the system. Her balance has crept up to roughly $16,700. The market's contribution stands at about $2,300. This is marginally better, but the pace still feels agonizingly slow. At the 5-year mark, she has contributed $24,000, and her account value is nearing $36,600. The market has now contributed $6,600 on top of her savings. This is beginning to feel more substantial, but Veronica is still performing the vast majority of the labor. Her contributions remain the primary driving force. By year 10, she has contributed $48,000, and her portfolio is worth roughly $76,500. The market has now injected over $28,000 that Veronica did not personally earn through labor or side hustles. That is starting to look like a meaningful sum, but it is at this juncture that the trajectory becomes genuinely disorienting. By year 15, Veronica has injected $72,000 of her own money, yet her account balance has surged to approximately $152,000. The market has generated a staggering $80,000 on her behalf, wealth that materialized not from her sweat equity, but purely from the passage of time. At year 20, her total personal contributions amount to $96,000. Yet her portfolio has ballooned to around $270,000. This means that $174,000 was created exclusively by the compounding mechanism. Veronica saved less than $100,000, yet compounding managed to nearly triple that figure. Finally, at the 30-year milestone, Veronica has invested a cumulative $144,000 over her entire lifetime. Her account now stands at just over $790,000. She personally sacrificed $144,000, while compounding conjured an additional $646,000 on top of that, generating more than 4 times her original contributions without requiring any additional effort, intelligence, or luck, only the simple discipline of staying the course. Now let us pause and ask a critical question. At which precise point in this 30-year expedition did compounding fundamentally shift from being a structure Veronica was building to a structure that was actively constructing wealth for her? The inflection point, the exact mathematical threshold, arrives somewhere between year 10 and year 14. That specific window marks a moment almost no commentator mentions. It is the period when Veronica's annual market-generated return begins to surpass her total annual contributions. Allow that to sink in because it is the fulcrum upon which all wealth pivots. There arrives a specific calendar year where the index provides Veronica with more capital appreciation than she herself deposits. The machine starts generating more output than you are feeding it, and that represents the decisive turning point. At year 10, Veronica's $76,500 portfolio, appreciating at 10%, produces roughly $7,650 in a single year. Since she is contributing $4,800 annually, the market is now granting her more per annum than she is adding from her paycheck. The flywheel has taken command. This is not a poetic metaphor, it is pure arithmetic. Once this threshold is breached, the trajectory bends in a manner that becomes almost impossible to comprehend, because each successive year operates on an expanded base, yielding larger returns, and the chasm between your deposits and the generated growth widens exponentially every cycle. A 10% return on $150,000 equates to $15,000 in a single year, exceeding what most families save in 12 months. A 10% return on $300,000 yields $30,000, and on $600,000 it yields $60,000, which is greater than the median American household income. You did not become a financial genius. The market did not suddenly become more benevolent. You did not alter any aspect of your behavior. You merely remained present long enough for the foundation to expand to the point where the arithmetic began operating aggressively in your favor. Now, let us quantify the brutal cost of missing this window. Commencing a decade earlier with identical contribution rates and the same return assumptions can more than double your terminal balance. This is not a marketing gimmick. It is the indisputable mathematical reality of exponential growth. If Veronica initiates her plan at 25 and invests until 55, she accumulates roughly $790,000 on just $144,000 deposited. However, if Veronica delays her start until 35 and invests the same $400 monthly until reaching 55, she will contribute $96,000 and culminate with roughly $270,000. This is the same individual, exercising the same discipline, purchasing the same fund, operating in the same market, yet a 10-year delay incurred a penalty of $520,000. That figure is not a typographical error. A single decade of procrastination eradicated more than $500,000 from her future security. This lost wealth does not materialize on any statement. There is no invoice, no collector's call, no admonishment from a banker. You simply arrive at the threshold of your golden years with a fraction of the capital you should possess, silently questioning what went awry. The data reinforces this grim picture. While the average retirement balance is quoted around $547,840, the median across all U.S. households with retirement accounts is merely $87,000. Half the nation possesses even less than that, indicating that the majority are either initiating their journey too late, withdrawing too early, or both. Here is an aspect that almost no one in the personal finance sphere dares to address, and I consider it the most crucial element of this entire discussion. The initial years of the compounding process are psychologically excruciating, even when the financial mechanics are perfectly sound. This is because human beings are fundamentally ill-equipped to sustain motivation through invisible progress. We are biologically programmed for immediate, tangible feedback, to react to stimuli we can observe and quantify in real time. In its nascent stages, compounding is ghost-like. You cannot perceive it. You cannot sense its relentless multiplication. You cannot watch it grow with the naked eye. You log into your brokerage account on a random Tuesday, noticing a meager $80 increase, and a cynical voice inside your head whispers, "Why am I even bothering with this charade?" Meanwhile, the external environment bombards you with tales of rapid enrichment. A friend flipped a house for a massive profit. A colleague hit a windfall on a tech stock. A social media acquaintance flaunts their cryptocurrency gains. And your monotonous index fund has eked out a mere 0.8% appreciation for the week. This environment fosters a dangerous self-doubt, making you question whether you are competing in the wrong arena. You are not. You are playing the correct game, but you are currently situated in the first half. This is the half where the tempo is lethargic, the scoreboard displays unimpressive numbers, and the temptation to exit the stadium before halftime is overwhelming. The second half is where the vast majority of the points are accumulated. Consider this practical analogy. In the absence of compounding, if you simply stashed away $300 monthly for 3 decades, you would have approximately $113,000. The remaining $254,000 generated in a standard compounding scenario is pure, unadulterated compound growth at work. No supplementary contributions, no visionary stock selection, no impeccable market timing. The sole variable is time, and the single requirement of you is unwavering patience. How then? Do you cultivate that patience when you feel absolutely nothing? The answer lies in changing your unit of measurement. If you measure your daily progress in dollar terms against a $1 million target, the sheer scale of the deficit will crush your morale every single time. The gap is too immense, the absolute movement is too glacial. You will feel like you are failing the mathematical test, even while you are executing the strategy flawlessly. Instead, measure your contribution consistency. Track the number of consecutive months you have invested without interruption. Acknowledge the fact that your capital is already deployed, already multiplying, already working while you sleep, while you exercise, while you are consumed by mundane daily activities. You are not actively constructing the wealth yet. You are constructing the machine that will eventually construct the wealth. These are fundamentally different operations, and the machine construction phase appears entirely unremarkable from the outside. There is another intangible asset you must fiercely guard during these early, fragile years, your time horizon. This is the variable that receives minimal attention, yet it stands as the most critical factor in the entire equation. Time horizon is not merely the length of time you intend to invest. It is the duration for which you keep the compounding chain completely unbroken. Compounding functions like a series of interconnected links. Every year you remain invested, that specific year's growth integrates into the foundation for the subsequent year's growth, which then integrates for the following year. Break that chain and you do not sacrifice just a single link. You forfeit every single link that chain would have produced in the future. Market downturns represent the greatest existential threat to this chain, not because the downturn itself is inherently fatal. Historically, every significant market crash has inevitably been followed by a robust recovery. The S&P 500 has never sustained a permanent downward trajectory without eventual remediation. However, a crash can unleash a primal reaction within you. Panic, visceral fear, the unnerving conviction that this time is fundamentally different. That sensation can compel you to liquidate your holdings. Selling during a downturn is the single action that transforms a temporary, unrealized paper loss into a permanent, concrete financial wound. By selling, you crystallize the damage, you miss the subsequent rebound, and you disembark from the compounding locomotive precisely as it prepares to accelerate out of the station. Patient investors who steadfastly endure periods of extreme volatility are the ones who capture the long-term average. That average, hovering near 10% annually, has persisted for over a century, surviving world wars, deep recessions, market crashes, global pandemics, and banking crises. It has never permanently failed. The only individuals who incurred lasting damage were those who succumbed to fear and exited prematurely. I want to internalize this moment from a subjective perspective because I suspect it differs significantly from popular expectation. Most people envision that when compounding kicks into high gear, there will be a dramatic, cinematic announcement. Some morning they will awaken, check their balance, and witness a shockingly visible upward leap. It does not operate that way. It is far more subdued. Perhaps you experience a month where you are forced to skip your contribution because of a tight budget. It happens. Yet you still notice that your balance advanced by $100 irrespective of your absence. Or you review your year-end statement and realize the market contributed a sum of $14,000 that year, while you only managed to deposit $4,800. The market effectively delivered nearly 3 times your own contributions. You pause and reflect. You ask yourself, when precisely did that begin to occur? That is it. That is the defining moment. That quiet, almost anticlimactic realization that the equation has inverted, that you are no longer the primary engine driving your account's expansion. That silence is the sound of the machine activating. Once activated, the mathematics become almost absurd, because now your base is sufficiently substantial that even modest market returns move the needle in ways that your early contributions never could. Your behavior has not evolved. You have executed nothing ingenious. You simply remain present month after month, long enough for the temporal dimension to assume command. So, what is the optimal course of action for you at this exact moment? If you are situated in the early accumulation phase, which we can define as having invested for less than 8 years, the single most effective action you can take is to automate your contributions and deliberately ignore the fluctuations. Configure your deposits to withdraw automatically from your checking account each month. Subsequently, resist the compulsion to monitor your balance obsessively. Refrain from checking it weekly. Resist the urge to adjust your asset allocation every time a sensationalist headline appears. The monotonous, unexciting act of simply maintaining your investment status is in itself the ultimate strategy. There is no superior alternative. Starting early is paramount because time plays the most decisive role in this equation. Commencing early, even with smaller amounts, affords your capital the luxury of extended growth cycles. Regular contributions exponentially enhance the compounding effect, analogous to a snowball that accumulates mass with each subsequent rotation. Every new deposit begins generating its own independent returns, contributing to the overall velocity of accumulation. If you are in the middle years, roughly 10 to 15 years into your journey, you should redirect your focus toward comparing your annual market returns against your annual contributions. You may already have arrived at, or be rapidly approaching, the inflection point. When your market returns for a given year exceed the total amount you personally deposited, mark that milestone explicitly. Acknowledge it. Savor it. Because this is the exact destination you have been marching towards since the very first day you initiated your first contribution. And if you are a late starter, perhaps in your 40s or 50s, and this serves as your urgent wake-up call, let me speak directly to you. The mathematics are undoubtedly more challenging. Yes, your timeline is compressed, but the underlying principle of compounding remains robustly functional. The inflection point will still materialize. It will simply arrive sooner, necessitating a more aggressive contribution strategy on your part. The statutory contribution limit for a 401 in 2026 is set at $24,500 for individuals under 50, while those 50 and older are permitted to make an additional $8,000 in catch-up contributions, bringing their total to $32,500. Individuals in this situation should seriously consider leveraging these maximum limits to accelerate their trajectory. Initiating late is certainly painful, but failing to initiate at all results in a permanent and irreversible deficit. Here is the unvarnished truth about compounding, stripped of all superficialities. It is fundamentally invisible at the outset. You cannot physically feel its mechanisms operating. It does not send you push notifications. It does not trigger a surge of dopamine. For the first several years of your investment life cycle, it ranks among the most unrewarding activities you will ever undertake, while simultaneously being one of the most consequential. The individuals who manage to forge lasting intergenerational wealth are not lottery victors, not overnight sensation stories, not beneficiaries of a single lucrative gamble. They are the people who quietly, permanently, and irrevocably alter the financial trajectory. They almost universally share a single characteristic. It is not an above-average salary, not a flawless series of stock selections, not an impeccable sense of market timing. It is simply this. They understood that the machine exists. They comprehended that it requires substantial time to warm up and engage. And they protected their investment horizon with the same fervent vigilance they would afford their most valuable physical possession, because it is more valuable than the money itself. The inflection point is not a myth. It is a mathematically precise reality. It will arrive on schedule, provided you allow it the necessary runway. But you must remain actively engaged in the game when it finally does. You must endure the tedious years, the invisible years, the years where your balance appears laughably trivial, and your ultimate objective appears impossibly distant. Survive those unglamorous years, and the arithmetic will seamlessly execute the remainder of the heavy lifting. The engine will ignite, the momentum will assert dominance, and the asset you have been quietly nurturing will begin building its own momentum, expanding at a velocity you could never replicate through manual effort alone. Start if you have not yet taken the plunge. Stay if you have already embarked. Most importantly, avoid obstructing your own success. Simply let the mathematics unfold.